Hello, this is Saurav Adva from Tax Accountant. So today I'd like to cover a video on imputation account. So I see students or business owners or person in general, we all receive dividend in some form or shape. So we're wanting to understand what dividend is and how the tax on the dividend work. So if you're a student, you might be wondering how to do that in your exam or things like that. But if you are an investor who received the dividend, who want to understand how the tax system work, or if you're a small business owner who want to understand how in general the dividend system work, so this is a video for you. I'll cover major parts of economies as well and see what's the fuss about dividend imputation system, dividend tax credit system, different countries, it's called a different name, and let's dig into it. So today I'll cover what is the dividend credit system and how the double taxation can be avoided through this. So what is dividend imputation system? So this is a part of dividend imputation framework, and the main idea is to avoid the double taxation and applies the tax credits at the shareholder level for company tax paid. So give an example. So let's say if company has a $1,000 profit, so if the tax rate is 28%, which means $280 tax is paid by the corporation, which is a company. Now the distribution, which is the balance left out of 280 gone, 720 left, so that 720 is paid as dividend to the shareholder. Shareholder will declare $1,000 as their income, and the $280 tax that has been paid will be used as tax credits. So they will not show 720 what they received, but they will gross it up. So $1,000 would be their income and $280 will be tax credits. So this is what the framework of the dividend system is. So tax paid by the company should not be paid again by the recipient. Now the tax credits of 280 is claimed as a tax credits. So if the recipient, who's a shareholder, if their individual tax rate is below 28%, right, they will receive a refund or to be offset against some other income. But if their individual tax rate is more than 28%, they will pay the difference. So this is in simplest form explanation of dividend imputation system. Let's explore how this will work with other parts of the world, and so let's dig into it globally to understand this concept a bit better. Now in New Zealand and Australia, we call it imputation credit systems. This is where I'm from. So this is called imputation credits fully integrated. So this is what called fully integrated means that whatever tax is paid by the company, that tax is provided to the shareholder. And similar system in Australia, it's called franking credits. So franking credits work very similarly and are attached to dividend. So this is in these two countries, it's called. In Canada, remember one thing, New Zealand tax system and Canadian tax systems are very, very similar in some form or a shape. And in a lot of tax cases in New Zealand, the baseline has been used as Canadian tax cases, and in Canada, New Zealand tax cases, and vice versa. So there has been some common ground in both tax systems. And they call it very similar system, but they call it dividend gross up and tax credit system. This is what they call it. And shareholders increase declared income, then claim a credit, which is a very similar system what we have in New Zealand and Australia. Now compare this to Singapore and United Kingdom. Now both had, so not right now, they both had imputation systems. Now these systems abolished in 1999 in UK and 2003 in Singapore, and now they both have a lower dividend tax rate. I'll explain you what that is. So basically what they are saying is, when corporations pay tax, so that tax is already paid. So when in my previous example, if that $720 is paid to the shareholder will declare that as their income, but they will pay tax at a lower rate. Sounds simple? It is simple, but I'll explain that in few more slides. Now, United States and Japan, again, they have a very similar system. No imputation system. Company pay profits and dividends are both taxed. So company profit and dividend both are taxed. But the tax of the dividend is at a much lower rate. So this is how they operate. Now, which system is better? So tax credits is passed in one system, and in another system dividend is taxed at a lower rate. Which system is better? So imputation system provides fairness and equity. So if you are a higher income earner, you will top up, but if you're a low income earner, you will get tax credits or offset in some other form or a shape, which helps low income shareholders benefit from company tax already paid. And no non-imputation systems simplify administration but allow double taxation. So they both are different. As you can see that if you do not have an imputation credit system, which means there is no administration of all that, how much tax company has paid, pass on from A to B and B to C, and all sorts of compliance is gone. However, double taxation may arise due to this. So in summary, imputation credits reduce double taxation, as in my previous example, the $280 tax credits is passed on to the shareholders, and shareholders will use that in their tax returns. This is widely used in New Zealand and Australia, and also in Canada. Systems vary globally in fairness versus simplicity. So one is a fairness, other is the simple. So USA and Japan going through more simple, whereas New Zealand, Australia, Canada is more going towards fairness. Now it considers shareholders' outcomes when evaluating tax systems. So both systems are equally okay, depending on what objective we want to achieve out of it. Now, if you have any questions, you can reach out to us. This is our email address, info@ibbz.co.nz, and this is our phone number. We'll be happy to answer should you have any question. And we'll also provide a link in the description which will explain that in more detail, the article which explain the dividend imputation system and how it compares to other parts of the world. Thank you for watching this. Please like and subscribe to our channel.